Hello students, welcome to the lecture on financial accounting, and after this lecture we will be able to learn the following objectives. Describe the financial accounting, explain the basic concepts and conventions, understand trial balance, explain depreciation method, understand the accounting process. Let us start with what financial accounting is. Financial accountancy or financial accounting is the field of accountancy concerned with the preparation of financial statements for decision makers such as stockholders, suppliers, banks, employees, government agencies, owners and other stakeholders. Financial capital maintenance can be measured in either nominal monetary units or units of constant purchasing power. The central need for financial accounting is to reduce the various principal-agent problems by measuring and monitoring the agent's performance and thereafter reporting the results to interested users. It is used to prepare accountancy data for people outside the organization or for those who are not involved in the mundane administration of the company. Management accounting provides accounting information to help managers make decisions to manage and enhance the business. In short, financial accounting is the process of summarizing financial data which is taken from an organization's accounting records and publishing it in the form of annual or quarterly reports for the benefit of people outside the organization. Financial accounting generates some key documents which include profit and loss account, patterning the method of business traded for a specific period, and the balance sheet that provides a statement showing mode of trade and business for a specific period. It records financial transactions showing both the inflows and outflows of money from sales, wages, etc. It empowers the managers and aids them in managing more efficiently by preparing standard financial information which includes monthly management report tracing the costs and profits against budgets, sales and investigations of the cost. Importance and benefits of financial accounting. It provides legal information to stakeholders such as financial accounts in the form of trading, profit and loss account and balance sheet. It shows the mode of investment for shareholders. It provides business trade credits for suppliers. It notifies the risks of loan in business for banks and lenders. Some benefits which financial accounting provides are maintaining systematic records. It is a primary function of accounting to keep a proper and chronological record of transactions and events which provide a base for further processing and proof for checking and verification purposes. It embraces writing in the original subsidiary books of entry, posting to ledger, preparation of trial balance and final accounts. Meeting legal requirements. Accounting helps to comply with the various legal requirements. It is mandatory for joint stock companies to prepare and present their accounts in a prescribed form. Various returns such as income tax, sales tax are prepared with the help of the financial accounts. Protecting and safeguarding business assets. Records serve a dual purpose as evidence in the event of any dispute regarding ownership title of any property or assets of the business. It also helps prevent unwarranted and unjustified use. This function is of paramount importance for it makes the best use of available resources. Now
meet Bob and Sandy. Like most people, Bob and Sandy have worked hard over the years to accumulate a nice nest egg for retirement, but they worry about losing money in the market, keeping up with inflation, and outliving their money. Without a comprehensive financial plan, they're not really sure if they're on track or not. So Bob and Sandy looked around for a financial advisor to help them out, including their closest friend Dave. But no matter who they saw, they kept getting the same cookie-cutter solutions. The advisors did not consider the legal or tax consequences to their plan. Then they heard about McLean Advisory Group, a local firm since 1983 with a tremendous amount of experience in helping everyday people to protect their assets with a low to no risk investment portfolio that increase their income, ensuring that they will keep up with inflation for years to come. McLean Advisory Group helped Bob and Sandy align their life goals with their financial plan, and they took the time to really get to know their situation, as well as their appetite for risk in these.
Now coming to the nature of financial accounting. The nature of accounting information has been dictated from time immemorial by the needs of the users of the day. The history of accounting reflects the pattern of social developments and the forces which necessitate the changes in accounting system from time to time. Over the years, accountancy has made tremendous progress in the field of commerce and industry. Accounting can be described as being concerned with measurement and management. Measurements of recording transactions and management with the use of data for making decisions are the two fundamental aspects. It is concerned with the measurement and communicating financial data. Financial accounting is based on double entry system of accounting, which comprises of recording of business transactions in the books of prime entry, posting into respective ledger accounts, striking balance, and preparing the performance statement, profit and loss statement, and position statement, balance sheet. Financial accounting is concerned with the collection, recording, classification, and presentation of financial data to serve the purpose of the management, shareholders, and stakeholders such as creditors, bankers, government, etc. Financial accounting is a useful tool to management and to external users such as shareholders, potential owners, creditors, customers, employees, and government. It provides information regarding the results of its operations and the financial status of the business. Some of the functional areas of financial accounting are dealing with financial transactions, recording of information, classification of data, making summaries, analyzing, interpreting the financial information, communicating the results.
The necessary assumptions or conditions upon which accounting is based are known as accounting concepts. Mr. A decided to start a business by the name A Enterprises with cash 3 lakh rupees, land worth 10 lakh rupees, machinery worth 2 lakh rupees, a total of 15 lakh rupees. Thus, Mr. A has introduced 15 lakh rupees in all. This is the concept of business entity. This amount of 15 lakh rupees is liability of A Enterprises and is shown in the books of accounts under the header Capital. Three months down the line, Mr. A needed money for his personal use. He withdrew 1 lakh rupees from the company. As the funds withdrawn were for his personal use, A Enterprises reduces the amount from the total payable to him. So, the firm needs to pay Mr. A an amount of 14 lakh rupees. This is the concept of business entity. Owner and the firm are two distinct entities by themselves. Any money, whether in cash or in kind, introduced in the firm by the owner is the liability of the firm. Any withdrawals by the owner for his personal use is drawings and reduces the liability of the firm.
There are also some limitations of financial accounting. One of the major limitations of financial accounting is that it does not take into account the non-monetary facts of the business like the competition in the market, change in the value for money, etc. Following are some limitations of financial accounting. No clear idea of operating efficiency, weakness not spotted out by collective results, not helpful in price fixation, no classification of expenses and accounts, no data for comparison and decision making. Basic concepts and conventions. An accounting convention is a modus operandi of a universally accepted system of recording and presenting accounting information to the concerned parties. They are followed judiciously and rarely ignored. Accounting conventions are evolved through the regular and consistent practice over the years to aid unvarying recording in the books of accounts. Accounting conventions help in comparing accounting data of different business units or of the same unit for different periods. These have been developed over the years. Some conventions are Convention of Relevance. The Convention of Relevance emphasizes the fact that only such information should be made available by accounting that is pertinent and helpful for achieving its objectives. The relevance of the items to be recorded depends on its nature and the amount involved. It includes information which will influence the decision of its client. This is also known as convention of materiality. For example, business is interested in knowing as to what has been the total labor cost. It is neither interested in knowing the amount employees spend nor what they save. The convention of objectivity highlights that accounting information should be measured and expressed by the standards which are universally acceptable. For example, unsold stock of goods at the end of the year should be valued at cost price or market price, whichever is less, and not at a higher price, even if it is likely to be sold at a higher price in the future. Convention of feasibility. The convention of feasibility emphasizes that the time, labor, and cost of analyzing accounting information should be comparable to the benefits arising out of it. For example, the cost of oiling and greasing the machinery is so small that its breakup per unit produced will be meaningless and will amount to wastage of labor and time of the accounting staff. Now, talking about the trial balance. A trial balance is a list of all the nominal ledger, general ledger accounts contained in the ledger of a business. This list will contain the name of the nominal ledger account and the value of that nominal ledger account. The value of the nominal ledger will hold either a debit balance value or a credit value balance. The debit balance values will be listed in the debit column of the trial balance, and the credit value balance will be listed in the credit column. The profit and loss statement and balance sheet and other financial reports can then be produced using the ledger accounts listed on the trial balance. These are some main objectives of preparing a trial balance. Trial balance helps in knowing the arithmetical accuracy of the accounting entries. Trial balance represents a summary of all ledger balances, and therefore, if the two sides of the trial balance tally, it is an indication of this fact that the books of accounts are arithmetically accurate. Trial balance forms the basis for preparing financial statements such as income statement, trading and profit and loss account, and balance sheet. In case the trial balance is not prepared, it will be almost impossible to prepare the financial statements. The entire ledger is summarized in the form of a trial balance. Thus, the position of a particular account can be judged simply by looking at the trial balance. Now, How to prepare a trial balance? The trial balance is usually prepared on a loose sheet of paper. The ruling of trial balance is similar to that of a journal. We may prepare a trial balance in one of the following forms. Total trial balance method, balanced trial balance method, total trial balance method. According to total trial balance method, two sides of each ledger account, that is debit and credit side, are added up and debit and credit totals so obtained are placed in the debit and credit columns of the trial balance respectively. Thus, we may draw the following trial balance by taking out the debit side total and credit side total of each account in the ledger. One clear defect of this method is that mistakes may be committed more often while preparing the trial balance because large number of figures would be required to be enlisted. Thus, the process becomes unwieldy and cumbrous. The task of preparing a trial balance under balanced trial balance method is much simplified. There is well-known axiom that if equals are subtracted from equals, the remainders are equal. On this assumption, in place of writing against each account the debit as well as the credit total, the balance alone is written. The difference between the two sides of an account is called the balance. If the debit side of an account is greater than the credit side, the balance falls on the debit side and is known as debit balance. If the credit side of an account is greater than the debit, the balance is on the credit side and is called credit balance. Final account is the combination of income statement and balance sheet. The final account is prepared at the end of every year, which may be a calendar year or other also. Normally, final account includes the following items: trading account, profit and loss account, profit and loss appropriation account, balance sheet. Now, talking about the depreciation, there are generally two methods for calculating depreciation. Straight line method. The simplest and most commonly used depreciation method, straight line depreciation, is calculated by taking the purchase or acquisition price of an asset subtracted by the salvage value divided by the total productive years the asset can be reasonably expected to benefit the company, called useful life in accounting jargon. Writing down value. It is the most widely used depreciation method both in US and abroad. Internationally, it is also known as the declining balanced method or fixed percentage of declining balances depreciation. It is also more often used in income tax statement when reporting earnings to the shareholders. But a lot of companies use the written down value method for the reporting purposes also. This method uses depreciation rate, which is up to twice the straight line depreciation rate, and applies it to the assets at the book value beginning of the period. Because book value for the next period would be lower than the value this year and the depreciation percentage is fixed, it follows that the depreciation next year would be lower than the depreciation this year for the same asset. Now, there are 2 points that you should be careful while calculating the depreciation using this method. As you can see from the table, the starting book value of $10,000 was depreciated at $40, resulting in depreciation expense of $4,000 and a book value at the end of the first year of $6,000. Now, the next year's depreciation is going to be charged at the same rate of $40, but on $6,000 and not on $10,000. This means that depreciation expense for the second year is only $2,400. Similarly, the book value keeps on going down, and in same manner, depreciation expense also keeps on going down. The financial accounting process consists of categorizing past transactions and events, measuring selected attributes of those transactions and events, and recording and summarizing those measurements. The first step places transactions and events into categories that reflect their type or nature. Some of the categories used in financial accounting include purchase of inventory, merchandise acquired for resale, sales of inventory, and wage payments to workers. The next step assigns values to the transactions and events. The attribute measured is the fair value of the transaction on the exchange date. This is usually indicated by the amount of cash that changes hands. If equipment is purchased for a 5,000 cash payment, for example, the equipment is valued at 5,000. The initial valuation is not subsequently changed. This original measurement is called historical cost. The final step in the process is to record and meaningfully summarize these measurements. Summarizing is necessary because otherwise decision makers would be overwhelmed with an extremely large array of information. Imagine, for example, that an analyst is interested in Ford Motor Company's sales for 1998. Providing a list of every sales transaction and its amount would yield unduly detailed information. Instead, the financial accounting process summarizes the dollar value of all sales during a given time period, and this single sales revenue number is included. The major steps involved in the accounting cycle are analyzing and recording transactions via journal entries, posting transactions to ledger accounts in the financial statements, preparing unadjusted trial balance, preparing adjusting entries at the end of the period, preparing adjusted trial balance, preparing financial statements, closing temporary accounts via closing entries, preparing post-closing trial balance financial accounting. Preparing post-closing trial balance financial accounting cycle is one of the most important concepts of accounting. The financial accounting cycle is the process of recording business transactions and processing accounting data to generate useful financial information. That is, financial statements including income statement, balance sheet, cash flow statement, and statement of shareholders' equity. The time period principle requires that a business should prepare its financial statement after a specified period of time, say a year, a quarter, or a monthly basis. This is achieved by following the accounting cycle during each period. Accounting cycle starts from recording individual transactions in the books of accounting and ends at the preparation of financial statements and closing process. Now in the end, let us summarize what we have learned in this lecture. Financial accounting generates some key documents which include profit and loss account, patterning the method of business traded for a specific period, and the balance sheet that provides a statement showing mode of trade and business for a specific period. Importance: provides legal information, shows mode of investment, provides business trade credit, notifies risk of loan to banks. Benefits: maintaining systematic records, meeting legal requirement, protecting and safeguarding business assets. Limitations: does not take into account non-monetary facts, no clear idea of operating efficiency, does not spot weakness, not helpful in price fixation, no classification of expenses and accounts, no data for comparison and decision making. Functional areas: dealing with financial transactions, recording of information, classification of data, making summaries, analyzing, interpreting the financial information, communicating the results. A trial balance is a list of all the nominal ledger, general ledger accounts contained in the ledger of a business. This list will contain the name of the nominal ledger account and the value of that nominal ledger account. Items of final accounts are trading account, profit and loss account, profit and loss appropriation account, balance sheet. The methods of depreciation are straight line method, written down value method. Steps of accounting process are place transactions and events into categories, assign values to these transactions and events, record and summarize these measurements.